Okay, well, I got well after 8 o'clock, so let's get going. Kind of get started here. Let me get the screen. Here we go. So, who won round 4? I didn't hear anything from the back row. Well, let's go take a look. Nobody is here from Chester, so I'm really going to pick on them today. Man, very few people here from Baldwin. Wow. Of course, they got the, let's see. There's,
Over here, we're solid.
okay, that's true. You're okay. Scattered a little bit, sorry.
Yeah.
Not many here from Digby, though. Just the two of you. We're just short. The basketball, huh?
I said there's not a lot of people.
No. That's why I'm looking at this. I'm saying, I know the basketball guys are gone, so I mean, I can understand. And I know Josh is gone because he's doing his thing. Our thing, I should say. But, okay. Well, let's go through it. I guess they'll miss out, so I'll just kind of pick on everybody today a little bit. So, we take a look down, and obviously sales, Ferris kicked butt in sales, but didn't make that much money. In fact, while they had $30 million more in sales than Digby made, what, $12 million more dollars? Okay, why is that? Should be able to tell just by looking at this. Yeah, contribution margin. Okay, Ferris actually had a little better SG&A. They probably spent a similar amount, just kind of looking at it, but they were a little bit more effective with their SG&A. But Digby's contribution margin is just, what, 16% percentage points more than Ferris. That's huge, right? On $200 million in sales, that's an extra 30 plus million in profit there, in gross profit. So huge deal. Okay. Chester bringing up the rear. That's why I'm going to pick on them a little bit today in terms of why they're bringing up the rear on their sales. It's too bad they're not here to get my advice, but maybe at least Josh will listen to the tape here. So we'll see. Maybe the others will as well. Who's Chester? Bedhassa, I can understand why he's not here. Josie and Tandy and Della. Well, okay. Pretty impressive contribution margins, though, all the way around. I mean, look at that. Everybody's over 40 with the exception of Ferris and Chester, and Ferris is just at 30. Might be one of the reasons why their sales are so big. Maybe they're sacrificing a little bit of contribution margin on price and whatnot. Just kind of making some guesses at this point in time. I can sure check on that. Chester obviously isn't sacrificing contribution margin for sales. Okay, how come Chester's not selling very much? You guys glance at that by any chance? You guys get any ideas? Okay, take a look at it when we get down and look at the individual segments. Maybe I'll kind of walk through it a little. Stock market summary. Digby, nice jump up in stock price. Other gains in stock prices pretty much throughout. Digby's got a market cap of $209 million. What's market cap? Shares outstanding times what?
Book value? Or is it book value? Stock price?
Okay, stock price. So number of shares outstanding times the stock price. Okay. Book value can be book value per share. So if you're looking at an overall book value, it'd be the book value per share times the number of shares. And that is going to give you a number. But generally speaking, that number is going to be smaller than the market value. Okay, if you look at real companies, their book value, in fact, oftentimes they'll give you a ratio of price to book value, market cap or price, stock price to book value. In banks, for example, it's not unusual for that to be 2 to 1, right? That the market price would be about twice what the book value of the stock would be. So in other industries, that can vary a little bit, but kind of depends on the growth, whatnot, of the company too. So Okay, looks like some companies did a few things maybe in there, but we'd have to probably go look at the cash flow to tell. Stock market summary, a lot of B's. What's junk? Junk bond versus, because these are bonds, so what's junk bond versus a investment grade bond? Anybody know?
Aren't they bonds that are risky?
That's the definition. You're exactly right. Yep. Yep.
Start from double B down.
Triple B down.
Double B.
Yeah, triple B is actually considered investment grade. Triple B is just one below A. Okay, so anything you got double B minus, that's not investment grade. That's actually considered a junk bond. Pretty close though, right? And obviously it's, there's a scale, and so something that's double A or double B minus really isn't much worse than a triple B, right? Okay, it'd be pretty similar. So, but that's important in the investment world. I'll probably ask some questions. I thought I'd better spend a little bit of time on this because I'll probably ask some questions about this as the semester goes on. So let's talk about it. I know Andrews, I think, issued some debt. I think it was last round. But let's take a look at it. This series number, what this means, at least in this game, and I'm not so sure that it isn't similar to what's in the real world. We can take a look at some of that. But this series number says 12.6S 2031. Any idea what that means? Okay. 12.6 is the interest rate it was issued at, exactly right.
And the last four digits
Is the maturity date, exactly. Yep. So the 12.6 is the interest rate, okay? Why do I have a yield here then? If this was issued at 12.6, why do I have a yield of 9.9? It's crazy, isn't it? Okay, that's what interest rates are in the marketplace, right? Okay, so interest rates have gone down since Andrews issued this particular bond. Okay, I can tell that by looking at this. Okay, I want you guys to try to get a little feel for this. Interest rates have gone down since Andrews issued this bond. Okay, 126.9 means this. Okay, that's what the current price of the bond is. If the bond had a $100 value, okay, and they don't issue bonds in $100 increments, probably 10,000 would be the increment, but 126.9 figure as a percent. Okay, so if it had a $100 value, that bond right now, if you wanted to buy it in the marketplace, you would pay $126.90 for it. Okay, the yield then is, if you paid that $126.90, the yield is what your yield is until this maturity date of 2031. Okay, you're paying more than the face value. On a $100 bond, you're paying $26.90 more than the face value. Okay, but this bond's paying 12.6% interest. You're going to get interest payments every year of 12.6%, which is quite a bit more than the 9.9%. Okay, but that's you calculate that. If you guys remember that from finance, we did a few of those, right? We put those right in the thing. We got the current rate, what the yield is, different things to figure out what the price might be, those types of things. Okay, so that's kind of an important chart here. It doesn't play a lot into our game, but I like you guys paying attention to it because it does mean a lot in the real world. When you're looking at investments and those types of things, or if you were a CFO of a big company that was issuing some bonds, it would be a huge deal. Okay, we did, and I didn't get into the investment side of the bank too much, but we had especially periods of time when we had far more in deposits than we had loans outstanding, and so we would have millions and millions of dollars that had to be invested. Okay, and these things are really meaningful, right? Because if we invested a bunch of money, let's say it went the other way. Let's say we invested a bunch of money at 10% and rates went up to 12%, our bond is worth a lot less money. And we'd actually have to take a write-off on our balance sheet. We'd have to take a write-off, an impairment charge, right, for the decrease in the value of those bonds. Okay? It could be kind of scary. Okay, and that's what happened in the financial crisis that we had 2007, 2008. So Alarm didn't go off?
What?
Alarm didn't go off?
It did, but I fell back asleep.
Man, I tell you. All right. So income, cash flow, some things like that. We take a look at it. You know, inventories went down quite a bit. Okay, so we had a pretty good reduction in inventories. Okay, accounts receivable, again, just kind of depending on what's going on with sales. See the action that we had here. We still have some teams. Look at Digby, had the biggest profit and also spent by far the most on plant improvements. So that would be a scary scenario if I wasn't Digby. Okay, I'd be very, very nervous that they could, win a round and still invest that kind of money into plant improvements, whatever those plant improvements might be. I don't know. Okay. Once again, I'll say though that an investment in plant improvements doesn't really have a huge impact on profitability, right? Because you're just trading cash for another asset. The only effect on profitability might be the interest that you're paying if you have to borrow money for that, okay, and the depreciation. Okay, you're certainly going to have some depreciation with those new assets. It's $50 million is going to be significant. Your increase in $50 million of assets is going to be somewhat significant, but not anywhere like the $50 million. Okay. Dividends paid. Andrew's still paying a dividend. Sale of common stock. Ferris. So our two computer teams are kind of messing around with those things. Purchase of common stock. Erie bought back a little bit. We see some debt. So we had some debt issued. That was this round then. Okay. Cool. Okay. But quite a bit of debt. 4 teams issued long-term debt. Early retirement of long-term debt, a little bit for Team Baldwin. Retirement of short-term debt. Of course, you're always going to have short-term debt that's retired. Whatever short-term debt you had from the prior round is going to retire every year, right? Cash from current borrowing. No emergency loans. Yay. Is this the first round that we haven't had any team with an emergency loan? I don't know. Yeah, that's a good positive, so that's good to see. Decent amount of cash on hand. Look at our two computer teams, Andrews and Ferris, lots of cash on hand. Again, I would argue that that's really poor cash management, though. They issued a $19 million bond, okay, and they got $47 million of cash on hand. Why? There is a reason that real companies do that, I'll tell you. For example, Microsoft has issued some bonds lately and they actually use it even just to buy back their stock. The reason for that is because all of Microsoft's cash is sitting overseas. Okay, and they've got, I don't know, 70, 80, 90 billion dollars sitting overseas. I don't know what it is. Okay, if they bring it back under current law, this is one of the proposed changes though, but under current law, if they bring that back, they have to pay 35% tax rate on it. Okay, we're the only nation in the world that charges companies extra for the money that they're making overseas. Okay, so Microsoft has no incentive to bring that money back to the United States. They just leave it overseas. Unfortunately, if they're going to do improvements, build factories, do those types of things, they might choose to do those overseas because that's where their cash is, right? Okay, but they're still doing things here in the United States. Well, Microsoft has a better credit rating than the U.S. government, so they can borrow money for really cheap. Okay, so what do they care if they borrow money right now at probably 1, 2, 2.5%? It's no big deal, right? And so there is some times when you would borrow some money even though you got a lot of cash on hand. I don't think that's the case in this game, right? This makes no sense in this game because we're not talking about foreign currencies and all those other things. We're just talking about good old USA here. So why they would have, $19 million in long-term debt, okay, and they borrowed $23 million in short-term debt, so $43 million. They didn't have to borrow either of those, and they'd have still had a positive cash balance, right? Now, that would have been a little tight. I could see them borrowing some in the short term, okay. So they're spending a lot of money on interest with that type of an arrangement, right? Okay. Either that, or you could argue that they could have invested some more in some other things, knock down the cash. Bless you. Okay. Cruise down, fixed assets. See, we've got big companies. We saw Digby invested a lot, right? So we would expect their fixed assets to be pretty good size. They invested just about $50 million, so it is big. Okay. Likewise, they have a big equity position now. Okay, so they're a big company, lots of sales. If you're going to have lots of sales, you got to be a relatively good-sized company. Okay, you can have less sales and be a smaller company and still do well. Okay, it's all relative in that case. You look at Erie, for example, almost half the size in terms of equity, right? Okay, so Erie could make, just looking at this, 60% of the profit that Digby makes, and their ROE would be similar. Okay, that's really back in the napkin type of figuring there, but that's kind of in that ballpark, right? Earnings per share, though, okay, that's going to depend on how many shares are outstanding and what they're doing with that kind of stuff. So, other fees, we see still some investment here. It looks like Erie and Baldwin invested a decent amount of money in TQM. Smaller amounts otherwise, but still some. Other fees, write-offs, variable, nothing in particular there. Still plenty of capacity, although Digby and Ferris are using capacity. We still have lots of capacity. Okay, we see other teams, Baldwin sitting on just abundant capacity, right? More first shift capacity than they made. Okay, so they're spending a lot of money maintaining facilities that they're not using to their full ability. Again, those ones don't pencil out easily. It's difficult to tell what the costs of having those idle facilities are. That's just not something that our financial statements really give us a lot of information that we can actually calculate. What's the cost of having idle facilities? Okay, there are costs in doing that. There's depreciation for sure, some of the maintenance costs and those types of things that you would have, right? Okay, and it's also the opportunity costs that you have, right? Because you got all kinds of money now invested in that facility, and if you took that money and invested it in some other things, right, it creates some other opportunities that you would have. So it's a huge opportunity cost when you're trying to maintain facilities that you don't need. We saw some big decreases in inventory. That's a good thing. Digby invested a lot of money. Oh, there's probably one of the reasons why they introduced a new product. Okay, so they spend a decent amount of money. It costs quite a bit of money to introduce new products, so that's part of it. Probably did some things over here. I don't know if they did capacity things. I'd have to go back to last round and see and make a comparison, but they probably did some things then, I would guess, in automation as well. But introducing a new product costs a decent amount of money. How do you pronounce that product?
It's just day. 2 Ys.
Day with an extra Y. Okay. Was that a typo or
No, that
purposeful?
was intended.
What's that?
It was intended.
Was it? Okay. Okay. Yeah, there's good information on here. I'm kind of sliding through it. I spent a lot of time on this in the past, but good information here on costs. Look at Erie's low end cost is down to $2.96 on the labor side. Okay, that's fairly impressive in round 4. Okay, my guess is that if they're aggressive, they keep pushing that down pretty easily. How low can you go would be a good question there. How low can you go? A 58% contribution margin just on that one product. That's pretty impressive. Although Digby had a similar contribution margin. Notice that one of the big differences there is that Digby had a price of $21, almost $20.75. Erie's price was $18. Okay. Erie probably, if we get to the low end, we'll see. I think that might be part of your assignment. It is. But Erie probably had more potential, right? And they didn't fulfill that potential. Two things they could have done then, right? Maybe produced more and sold more at that price, or, obviously then they could have had a higher price and probably still sold at least as many, right? Okay, which would have increased their gross profit. Okay, I think the question that I have for your assignment is going to be kind of interesting because it might give you an idea if just in this one segment, if it might have been enough to push Erie's profits high enough to be a little bit more competitive with Digby. Okay, it'll push us in that direction a little bit anyhow. I don't think we get to the final resolution of that question, but it'll certainly push us in that direction. Yeah, boy, we're seeing some nice low. Look at Chester's traditional product there. Labor cost down to $2.32. $3.35 for Digby's, $2.96 there. So automation probably, big reason, up to 9.2 automation there, so huge. Okay. What does 1,000 units of MTBF, if you want to call it units, what's that cost you? Any idea? That'd be good to know. Okay. Traditional end, we met supply and demand, or had enough. Digby had a little more potential there, so they could have stuck it to you guys even a little bit more, maybe. Okay. So they gave up a little bit. We see a decent crowd there. We're still selling some of these in the outside. Again, as the game goes on, you know, we're going to get some more separation there, and so some of these products that are maybe selling a few here, and they're pretty minor even at this point in time, but they would probably fall off the radar screen. Okay, Ferris has pretty much exited their position there. Chester's low in the traditional. Why is Chester low in the traditional segment? Okay, and again, it kind of gets back to the efficiency and effectiveness of their SG&A. Let's go take a look. I said I was going to pick on Chester a little bit, so Della, you're going to get the brunt of that. Okay, 7% of the market, they sold 690 units. Why didn't Chester sell really well? What's the number one factor for customer buying criteria for the traditional segment? And how old is Chester's product? Yeah, that's old, isn't it? You know, that's like older than dirt. Okay, they're lucky they sold 7%. Okay. And here's a hint for Chester, okay? Hint for Chester. It looks like they're drifting their products, allowing their products to drift back, okay? But in order to maintain some relevancy, sometimes you have to at least tweak the R&D. You don't have to move it much. Sometimes just move it one little notch or something, so it's still going to kind of drift back a little ways, but that will change the age profile. Okay, so there's a little hint as you're drifting products back. You got to still. They're probably not spending any money on R&D, and that's one of the goals of that strategy is to not spend a lot of money on R&D. But if you spend just a little bit and just tweak that product a hair, I mean, you might just move the performance deal one notch, right? 1/10 of a notch, I should say. Okay, and that might be enough then to bring the age down. It's going to be perceived as being a change, and so the customers are going to look at it and they bring the age down. So that might allow them to compete a little bit better. That's one of the reasons why their sales are so low there, and we'll see some similar things, I think, as we go down. If we look at the low end, Chester, again, they're down here, right? Okay, well, it's a little different story here, but what's the number one selling criteria for the low end? Price, and what team has the highest price? Chester. Okay, so not paying attention to the customer buying criteria, right? In this case, it's not so much the R&D and the spending in there. They're fine because they're similar, right? Cedar's got the same performance and size coordinates as the top four. Okay, MTBF, it's got the same as the top two and 3 out of the top 4. Okay, age is fine, same as the top 4. Not much in promo and sales, so that might be a little bit of a factor there. But a bigger factor, I'm going to tell you, I mean, the top of the range here is $23, and they're at 22. You know, and you got the team, the top selling team, which sold out, was Erie, okay, their Ebb product, and they were at 18. So they were a full, you know, $3 or $4 cheaper than Team Chester, okay. Again, one of your questions on your assignment this week is going to be Erie's potential versus actual here. And I said I'm going to take it to that next step where you're going to have to calculate for me what the gross profit is that they missed out on. Okay, so we're going to have to go with marginal costs. I'll run through that when we go through the assignment a little bit. High end, Ferris kind of dominating the high end, and you can kind of see if you look over here, and this is a little small, but you know they got their products right out here at the front edge. Okay, the youth student teams have done a reasonable job. Digby's staying pretty close. It looks like Chester introduced a new product that's hanging right in there. Okay, Andrews is just kind of picking up a little bit of scraps. It kind of looks like, but a lot of the student teams are staying pretty close to Ferris up here, but Ferris is still dominating. Okay. That takes a commitment right from the front edge, number one, to keep your products up there. Okay, and 2, then introducing some new products that are right out there at the front edge. Again, Chester's probably, here we got an age thing again, right? Because age is a big factor here at the high end. It's the number 2 factor. Ideal position's the number 1 factor, but age is the number 2 in a reasonable percentage. And, we got a little age problem here because they want it to be close to 0, is it? Yeah. So you want to get your age down as low as you possibly can, and they're at 2 1/4, or 2.35, I'm sorry. So up there a ways. Okay. Their citrus product, they introduced that new product. Citrus is sold out, probably because you're limited as to how many you can make that first year you introduce one. Performance, we see, 3 teams have kind of vacated this area. Andrews is on its way out. It won't be competitive unless they expend a lot of money, and they're obviously not going to. That's one of your questions that'll come up on your assignment, though. So there's 3 teams that are competing in that. Lots of opportunity for those teams, right? Okay, lots of opportunity for those teams. Size, same thing. 3 teams. Absolutely just 3 teams left. Andrews, again, exiting that. So you got 3 teams competing there. And interesting. Could create some tactical opportunities. Okay, the actual and potential, we were looking at, was it Team Erie that gave up? Yeah. I got to check one thing because I didn't look. Did Team Erie, they only had, Ebb was the only product that was selling in the low end, right? No. Okay, so your assignment, here's a hint for your assignment. You're going to have to analyze 2 products, okay? Because Erie had, EAT sold a little bit in the low end. It had a potential of 3.9. It actually had actual sales of 4.4, so it sold more, okay, than its potential, okay? But its Ebb product had a potential of 30% and only sold 22.5 because it ran out, okay? So when you look at your assignment for this week, you're going to have to consider both of those products and the net effect, okay? Actually, they did a little bit better with EAT than you would have expected, but they did far worse with Ebb because they sold out, okay? The perceptual map, again, boy, look at performance and size. You get real domination there by Team Ferris in terms of sales. But not a good contribution margin yet. Maybe they're not taking advantage of pricing power that they would have in those segments. I'm not sure. I didn't look when I was up there. Are they not taking advantage of pricing power? Yeah, they're the lowest price there, but they're right at the top of the range, so it'd be tough. You can go above the range, by the way. Okay, you're going to hurt sales, but you can't go above the range. But there is a limit to how far you can go above the range. It's in your guide. I gotta check one more thing up here. Sorry, gotta scroll back. I just want to see. Okay. Human resource, we're seeing good investment here, good impact on productivity all the way across. It's one of those things where you got some teams doing it, and if the other teams aren't following suit, they're, it can bury them a little bit. Okay, so it's kind of even, sort of, kind of, from the, Chester, Digby, Erie's doing kind of okay, right? So nobody's gaining a real competitive advantage here, but if you weren't keeping up, then you'd be taking it the shorts. So one of those things you got to kind of keep up. TQM, we see some pretty big numbers, right? We're seeing some big material cost reductions, labor cost reductions. You're looking at 10% reductions in their total variable costs. 120 million, something like that, more than that for Team Digby. So you're talking about roughly a $10 to $15 million reduction in costs right there because of the investments that they've made. That's huge. R&D cycle time, big deal, especially as you move forward, huge. Administrative costs are so-so. Demand increase could be a big deal. Erie is picking up the pace there quite a bit. Might have been one of the reasons why they had pretty good potential in the one. So, any questions about that? Kind of whipping through it. I'm trying to whip through these, trying not to spend too much time, but hopefully explaining a few things. Let's take a look at the assignment for round 4. Number one, Erie stocked out in the low end. What was the cost and gross profit? I said, please show all work necessary. So I kind of gave you the steps. I'm getting soft or easy in my old age, I guess. So I kind of give you the steps, right? You got to calculate the percentage difference between the actual and the potential. Again, you got two products, right? There's two products there that you have to worry about. So one went one direction and one went the other direction too. So we're going to be looking at the net effect here. Okay, B, the number of units and missed sales. Okay, and you'll have to keep that. In one case, they actually had excess sales. Okay, because their EAT product, which was typically a traditional product, sold some in the low end, and they actually sold more than their potential was, and so they actually they'll have a positive number there. Whereas for their EB product, they're going to have a negative number. Okay, so you want to calculate those separately. Okay, calculate those separately. Amount in dollars resulting from missed sales. This one you could probably net out then, right? Okay, and then the marginal gross profit per item. Ooh, that might be wrong then too. You wouldn't be able to net it out in C because you're going to have to figure out the marginal amounts here in D. Okay, what do I mean by marginal? Let's go take a look at that. Okay, because I know that one. You guys are giving me that look. Okay. Basically giving you the answer here, so pay attention, right? EBS price, $17.99. EBS labor cost, $4.41. EBS labor cost, $2.96. So its total variable cost is $7.37. Okay, $7.37. Its gross profit per item then is what, $10.62? I'm doing that quick math in my head. Don't write that down. Figure it yourself because I was doing it in my head. So, okay. But that gives you then what its marginal gross profit per item is. Okay. That may or may not be the same as what the contribution margin was. Again, it depends on if they had inventory left over from last round, and I don't know unless I go back and check. But in this case, what I want to check, I got it. I got the numbers that I need right here. Okay, my marginal. Yeah, I was thinking of something else, but okay. And then we're going to calculate the total amount of gross profit missed, right? So I gave you gave you the calculation there for gross profit per item. You just multiply that by the units that they missed out on selling. Okay. And again, you're going to have a net thing here, though, because one they actually benefited and one they actually went down. So you got to net that out. Okay, what will be the total industry unit demand in the high end for round 5? Show your work. I asked that question this round because what's happening to demand next round? Anybody look ahead?
It's going down.
Ooh, we're going to have a recession. Bugger. Okay. Okay, so we're going to have a recession. So everybody kind of wake you guys up, make sure you're looking at that and at least calculating it here for one segment so you kind of have an idea then what's going to happen, right? Okay. I'll probably in the future, I'll certainly ask some questions that will be, what's the demand minus the inventory type of a question, right? In other words, what's the total, the way I'd phrase that is what's the total production necessary for next round? Okay, which is going to be a demand minus inventory type of a question. So, okay, 3. Andrews issued nearly $19 million in long-term debt. What was the effect, if any, on, and no math required here, what was the effect, if any, on ROE and EPS? Okay, explain to me if there was an effect, okay, and it was a small effect because, it was a, big effect because, or ROE went down because, or ROE went up because, and maybe a little explanation as to how you came up with that. Okay. 4. What is Team Andrews' strategy? When I ask this question sometimes in the past, I get some of the weirdest convoluted answers. People try to explain all kinds of weird things. Okay. How many strategies are there possible in this game? How many possible strategies are there in this game? 6, Eric says. Yes. Give that man a cigar. You like cigars?
Yeah.
Really? Okay. Cool. Okay, there's 6 possible strategies. Pick one. That's all I'm asking you to do here. I don't need a paragraph as to you trying to tell me what all they're doing. There's 6 possible strategies. Pick one. Okay? Don't guess. You know, take a look at what Ferris is doing. You should be able to figure it out. Okay? Should be able to figure out what Ferris got going on. So, okay? Or Andrews, I'm sorry. You should be able to figure out what Andrews got going on. You should be able to figure out what Ferris has going on too. Okay, neither one should be a real complicated question if I asked for either team. So, okay. Questions about the assignment? Due Tuesday morning, 7:59 a.m. Okay. Will I post the assignment? God, you guys are asking for an awful lot. You didn't write it all down here? Yeah, as soon as I shut it off here, I'll get it posted. I'll post the winner thing so you guys can take a look at that. So take me a few minutes. But any questions then other than that? I posted last week's, didn't I? I hope I did. Okay. All right. I'll turn this off.